All right, everyone, buckle up because the market is absolutely on fire, and you are not going to want to miss a single second of this. We've got seismic shifts happening across the board, with new strategies emerging and major players making bold moves that could redefine the entire landscape. The pace is relentless, the news is dropping faster than ever, and if you want to stay ahead of the curve, you've come to the right place. Get ready for the unmissable updates that everyone will be talking about. Let's dive in. First up, we're breaking down a massive strategic play that's got everyone buzzing. Is this the moment to jump in before the next massive surge? We've got the details on how a major figure is navigating the current climate and positioning for what could be an all-time high. Then, we're talking about continued accumulation, even when the market dips. One of the biggest public holders just added a significant amount to their reserves, signaling unwavering confidence. But is the pace changing? We'll explore the strategy behind these moves and what it means for the future. Next, the world of institutional investment is making waves. We're seeing massive inflows into new financial products, with significant amounts being allocated by major players. Who is driving this trend, and what does it signal for mainstream adoption? And finally, we're diving deep into potential market shifts. Whispers of corrections are in the air, but could this be a contrarian opportunity? We'll look at the data and the big picture to see if a major migration of assets might actually be a signal to buy. Don't go anywhere, you need to know this. Make sure you're subscribed and have that notification bell on so you never miss an update. A strategic entry point revealed. In the dynamic world of finance, timing can be everything, and recent developments suggest a potentially pivotal moment for a major asset. We're seeing signals that could indicate a strategic entry point, especially for those looking to position themselves before a potential next all-time high. This isn't just about market fluctuations, it's about understanding the underlying forces at play and how a significant public figure is leveraging them. This particular individual, known for a bold approach to market participation, has been making substantial moves. The current climate, marked by both volatility and opportunity, seems to be viewed not as a deterrent, but as a prime time for strategic acquisition. Reports indicate a significant accumulation of assets, a move that has historically preceded substantial price appreciation. The strategy appears to be one of long-term conviction, aiming to capitalize on what is perceived as an inevitable upward trend. The question on everyone's mind is whether this aggressive accumulation, particularly in the face of potential market corrections, is a sign of foresight or an indicator of an impending downturn that the public is missing. Digging deeper into the specifics, the rationale behind such a concentrated approach is multifaceted. It involves a belief in the fundamental value of the asset and a calculated assessment of its future trajectory. The current market conditions are being analyzed not just for short-term gains, but as a stepping stone towards achieving new record highs. This involves a deep understanding of market cycles, investor sentiment, and the broader economic landscape. The involved parties are not just passively observing, they are actively shaping their positions based on a forward-looking strategy that anticipates significant growth. The narrative being pushed is one of resilience and strategic advantage, suggesting that those who understand the underlying mechanics can indeed find opportune moments to enter the market, even amidst prevailing uncertainty. The impact of these moves is being closely watched by analysts and investors alike. There's a palpable sense of anticipation as to whether this aggressive strategy will pay off, potentially setting a new benchmark for asset performance and market entry tactics. The community is abuzz with speculation, debating the merits of buying into strength versus waiting for dips, and how this particular approach might influence broader market sentiment and future investment decisions. But is this the only big story unfolding? The market is a complex ecosystem, and while one major player makes a bold statement, others are quietly building their positions. Stay tuned as we reveal the latest moves from one of the biggest public holders in the space, and what it means for their long-term strategy. Continued accumulation amidst fluctuations. In a market that often swings with significant volatility, one prominent entity is demonstrating unwavering commitment to its long-term strategy, continuing its acquisition of a key digital asset even as prices experience temporary dips. This sustained accumulation signals a deep-seated conviction in the asset's future value, regardless of short-term market sentiment. MicroStrategy, a company led by Michael Saylor, a vocal proponent and one of the largest public holders of Bitcoin, has once again expanded its holdings. The company recently announced the purchase of an additional 3,081 Bitcoins for approximately $356.9 million, acquiring them at an average price of $115,829 per coin. This acquisition occurred shortly after a brief dip in the asset's price, a move that highlights Saylor's philosophy of strengthening positions during market corrections rather than waiting for prices to stabilize or rise. This latest purchase brings MicroStrategy's total holdings to an impressive 632,457 Bitcoins, acquired at an average cost of $73,527 per Bitcoin, representing an investment of roughly $46.5 billion. Despite current market prices, the company remains substantially in profit on its overall investment, underscoring the success of its long-term accumulation strategy. This recent acquisition follows smaller purchases earlier in August, where the company acquired 430 and 155 Bitcoins respectively. While the total of 3,666 Bitcoins acquired in August is significantly lower than the 31,466 Bitcoins purchased in July. This slowdown in the pace of acquisition is being interpreted by some analysts not as a weakening of conviction, but perhaps as a strategic pause or an adjustment to the acquisition rate as the company aims to meet its internal performance targets. Saylor himself has famously stated his intention to buy the top forever, viewing Bitcoin not merely as a speculative asset subject to market cycles, but as a fundamental store of value whose price is destined to increase over time. This perspective frames every purchase, whether at lower or higher price points, as a step within a larger, long-term trajectory. MicroStrategy's strategy is not without its scrutiny. As the pace of accumulation moderates, some observers are questioning whether the company is preparing for a more pronounced bullish cycle or reevaluating its approach. However, the company's internal performance indicators suggest continued bullishness. In July, MicroStrategy raised its targets for Bitcoin yield, the metric measuring the variation between its holdings and diluted shares, from 25% to 30% for 2025. Additionally, its gain target on Bitcoin was adjusted from $15 billion to $20 billion. The company already surpassed the 25% mark in July, with the indicator reaching 25.4% earlier this week. Furthermore, gross Bitcoin gains since January have been substantial, adding over 113,524 Bitcoins to its reserves. This momentum suggests that MicroStrategy is not only focused on accumulating Bitcoin, but also on optimizing its financial outcomes tied to its Bitcoin holdings. The apparent slowdown in buying could be a tactical maneuver to better align with these adjusted goals, without compromising the overarching ambition of making Bitcoin a core component of the company's shareholder value proposition. While one major player continues its steady accumulation, the broader investment landscape is also shifting. Institutions are making their presence felt in a significant way, reshaping market dynamics. Let's shift our focus now to how institutional investors are pouring billions into new financial products, and what this massive influx means for the market's future. Institutional investors pour billions into Bitcoin ETFs. In a significant development for the digital asset space, institutional investors have collectively amassed over $33.6 billion in Bitcoin exchange-traded funds, ETFs, by the second quarter. This substantial allocation highlights a growing mainstream acceptance and integration of Bitcoin as an investment vehicle within traditional financial portfolios. The data reveals a pronounced trend where financial advisors are leading this charge, currently holding approximately $17.4 billion in Bitcoin ETF positions. This figure nearly doubles the $9 billion exposure held by hedge fund managers, indicating that a broader base of financial professionals, beyond the more traditionally speculative hedge fund sector, is now actively investing in Bitcoin through regulated products. This shift is crucial because it signifies a move from niche or early adopter investment to a more widespread adoption by established financial advisory services, which often cater to a larger and more conservative client base. The implications of this institutional embrace are far-reaching. For Bitcoin ETFs to attract such significant capital, they must meet rigorous regulatory standards and demonstrate a reliable mechanism for tracking the underlying asset's performance. The success of these ETFs suggests that the infrastructure for investing in Bitcoin has matured to a point where it is palatable for traditional financial institutions. This increased demand from institutional players not only provides liquidity to the market, but also lends a degree of legitimacy and stability to Bitcoin as an asset class. Furthermore, the substantial holdings by advisors suggest that these professionals are not only investing their own capital, but are also recommending Bitcoin ETFs to their clients, further embedding digital assets into the mainstream investment conversation. The growth in Bitcoin ETF holdings can be attributed to several factors, including the increasing regulatory clarity surrounding digital assets in various jurisdictions, the growing recognition of Bitcoin as a potential store of value or inflation hedge, and the convenience offered by ETFs for investors who wish to gain exposure without the complexities of direct custody or trading. The sheer volume of assets managed by advisors indicates a strategic allocation within diversified portfolios rather than a speculative bet. This suggests a belief in Bitcoin's long-term potential, aligning with the asset's historical performance and its increasing adoption by corporations and governments. The market impact is evident in the increased stability and reduced volatility observed in Bitcoin's price movements, partly due to the consistent demand from these large-scale investors. Analysts suggest that this trend is likely to continue as more financial products gain approval and as investor education around digital assets improves. The substantial capital flowing into Bitcoin ETFs represents a significant step towards the broader integration of cryptocurrencies into the global financial system, marking a pivotal moment in the evolution of digital asset investment. As institutional money flows in, it's easy to get caught up in the upward momentum. But what happens when the big players start to move their assets? We're going to look at potential market shifts and a contrarian play that could emerge if major holders begin migrating their positions. Whale migration signals potential correction below $110K. In a market characterized by constant flux, a significant shift in the behavior of large-scale holders, often referred to as whales, could be signaling a potential price correction for Bitcoin, with some analyses suggesting a move below the $110,000 mark. This potential downturn is being observed within a broader context of a changing macroeconomic landscape. The term whale migration refers to the movement of substantial amounts of Bitcoin from long-term holding addresses to exchange wallets or new, unknown addresses. Such movements are often interpreted as a precursor to selling activity, as whales may be looking to liquidate their positions or rebalance their portfolios. Recent on-chain data and market analysis have indicated an increase in such activities, prompting concerns about downward pressure on Bitcoin's price. If a significant number of these large holders decide to sell, it could trigger a cascade effect, leading to a price drop that breaches key support levels, such as $110,000. This potential correction is occurring against a backdrop of evolving macroeconomic factors. Global inflation rates, interest rate policies from central banks, and geopolitical tensions all play a role in shaping investor sentiment and asset allocation strategies. While Bitcoin has often been touted as an inflation hedge, its performance can also be sensitive to broader market risk appetite, which is heavily influenced by these macroeconomic indicators. A tightening monetary policy or an increase in global economic uncertainty could lead investors to reduce their exposure to riskier assets, including cryptocurrencies. However, within this bearish outlook, some analysts are identifying a potential contrarian play. This strategy involves looking for opportunities to profit from an anticipated downturn, or conversely, seeing a price dip as a buying opportunity if the underlying fundamentals remain strong. For contrarian investors, a potential correction below $110,000 might not be a signal to exit, but rather an attractive entry point to accumulate more Bitcoin at a lower price, especially if they believe the long-term trajectory remains upward. The argument for this contrarian view often rests on the continued institutional adoption, the ongoing development of the Bitcoin ecosystem, and the asset's limited supply. The community's reaction to these signals is mixed. Some are expressing concern about the potential for a significant price drop, while others remain optimistic, emphasizing that corrections are a natural part of any market cycle and that the long-term outlook for Bitcoin remains robust. The debate often centers on whether the current whale migration is a sign of genuine distribution and profit-taking, or simply a reallocation of assets by sophisticated investors who are still committed to the digital asset's future. The ultimate impact will depend on the scale of the selling pressure, the response of retail investors, and the broader economic environment. So, we've covered strategic plays, continued accumulation, institutional inflows, and potential market shifts. It's a lot to take in. But before you go, let's quickly recap the biggest headlines of the day and make sure you're subscribed so you don't miss a single update. And that's a wrap on today's essential updates. We saw a major figure positioning for potential all-time highs, MicroStrategy doubling down on its Bitcoin accumulation strategy, a massive $33.6 billion surge in Bitcoin ETF holdings by institutions, and signals of a potential Bitcoin correction amid whale activity. Don't miss out on any of these critical developments. Hit that like button, subscribe to Bitcoin Bulletin, ring that notification bell, and join the conversation in the comments below. Plus, follow us on all our social channels for even more real-time updates.